Hello traders! In this video, we will look at something that is closely related to trading itself. And if you won't understand this, blowing up your account will be inevitable. It is trading with margin. In this video, we are not only going to cover margin, but all the other things that will help you efficiently manage your trading business. Because Forex trading is much more than just buying and selling currencies, you must be aware of all the nuances that can happen to your account. Margin trading. Thanks to margin trading, you can enter position bigger than your account balance. So, in theory, you don't need a large amount of money to make a large amount of money in the Forex trading. Unfortunately, for many new traders, this can be a double-edged sword since you can lose a large amount of money even faster. You can think about margin as collateral for your broker. They let you open the larger position, but your margin is used to cover any losses you might occur. The margin requirement is the percentage amount of margin you have to provide when you are opening a new position. These differ at different brokers. As an example, if you have a 2% margin required on Euro-USD, it would mean that for one lot, which equals $100,000, you need $2,000 in your margin account to be able to open this position. This 2% or $2,000 cannot be used for anything else as long as your position is opened. Once you close the position, these $2,000 will be released. Required margin is sometimes also called entry margin, initial margin, or maintenance margin, all the same. Required margin is calculated when you multiply a notional value with margin requirements. Using the Euro-USD example, you multiply 100,000 by 0.02, which is the 2% margin requirement, and you will get $2,000. If you have multiple positions open at the same time, you might see the term used margin or total margin. This is simply all margin you are currently using to maintain all position opened. Opposite of that is free margin. These are money that is not locked up in any position, so you can freely use them to trade. When your free margin is at 0 or less, you will receive a margin warning saying that you should deposit more money, and of course, you are not able to open any new positions. Free margin is sometimes called available margin. The margin level displays the percentage ratio between your equity and the used margin. For example, if your equity is $5,000 and the used margin is $1,000, the margin level is 500%. Account balance and equity. The account balance represents funds that you transfer to your trading account. It is simply the money you have in your account. So, if you deposit $10,000 to your trading account, your balance is $10,000. If you open a new trade, your account balance won't change until the position is closed. The only times when your account balance is changed is when you add more funds, or if you close open position, or you hold a trade overnight. As the first two cases are very straightforward, holding position overnight can get a bit complex. Overnight in Forex is called a rollover. During the rollover, a swap is calculated. Swap is a fee that is either charged or paid to at the end of the trading day. Balance increase if you are paid swap and decrease if you are charged swap. Equity represents the current value of your trading account. If you have no position open, your equity equals your trading account balance. But if you have a $10,000 account balance and currently have open trade that is on $1,000 profit, your equity is $11,000. The same goes for negative. If the trade would be running in $1,000 loss, your equity would be $9,000. Equity will constantly fluctuate until all positions are closed. So it is a real-time calculator of your profits and losses, compared to balance that only shows profits and losses from closed positions. This is why we at FTMO care about your account's equity when you undergo our evaluation process or trading on an FTMO account. It is because the balance does not display a real amount of funds on the account. For example, if you have a $100,000 account, but currently sitting on floating loss of $90,000, you have only $10,000, not 100 as your account balance states. Floating and realized P&L. Floating and realized P&L is closely tied with balance and equity. Floating P&L shows profit or loss in your equity balance. This is the profit or loss of trades you have currently open. So, if you went long on gold at 1900, but the price is currently sitting at 1880, it means that you are down 20 points. Your floating P&L would be negative, depending on your position size. If 1 point is worth $1, you are down $20. If it's worth $100, you are down to $1,000. If you are down these 20 points and you decide to close a trade, it becomes realized loss. If you would be up to 20 points, it becomes a realized profit. Realized P&L represents gains or losses that have been converted into your account balance. In trading and everything else, profit is not real until it is realized. Unrealized profits are theoretical on-paper profits. Margin call and stop-out level. Margin call represents a specific percentage level. When this level is reached, you won't be able to open any new positions. Margin call level is determined automatically in your trading platform. For example, if your margin call level is 100%, it means that if your margin level reaches 100%, you won't be able to open any new position as your account is under margin call. Although a lot of traders think that margin call means that their trades are getting closed, that is not correct. Margin call just gives the trader a warning. Stop out level is the specific percentage level where, if your margin is equal or below, your broker starts closing your position until the margin level is greater than the stop out level. If we say that stop out level is 70%, it means that if the margin level falls below 70%, stop out level automatically occur, and positions with largest floating loss will be liquidated. The process is repeated until the margin level increases to above 70%. To recap this, a margin call is just warning that traders receive when they breach the margin call level. Stop out happens when the stop out level is breached and the positions start to get liquidated. And how to avoid a margin call? Avoiding a margin call is not hard. All you need to do is follow proper risk management. This includes using stop losses that will get you out of the trade way before a margin call. But it can occur in some rare situation where stop losses might not help. During high impact news and flash crashes, traders could experience slippage. This means that your stop loss fills at much worse price than you expected. This situation cannot be 100% avoided, but traders can prevent them by watching the macroeconomic calendar and using smart money management. Alright traders, this is it for this video. I hope you have enjoyed this video, and if you have any question or you are just interested in something, just let your comment down below. Please don't forget to subscribe our YouTube channel, and I wish you steady study and see you next time.